Now, whenever we bring in the concept of value at risk, it is primarily an estimate of the money that is at loss. The value or the amount, it is majorly quoted in terms of amount or the value which is at a risk or loss. So, one thing, it is a probabilistic measure only. It is not a 100% accurate kind of a number. It is a probabilistic number. So it's not something which is certain that this is the loss. We are not talking about that as the value at risk. Value at risk is always defined with respect to level of confidence. Either we talk about 95% confidence level, 99% confidence level, 99.9% confidence level. Some such kind of a confidence level is what is associated with every definition of the VAR, and that number is selected by the user. So it is a measure of the volatility that is associated with the company's assets. If that particular asset is fixed, the value of the asset is fixed, it's not volatile at all, its value does not change for the entire period, then the standard deviation is 0 and even the value at risk is also 0. Right? Just because the underlying asset will have fluctuating values, the value at risk is computed for that particular kind of instrument. So if the volatility of the prices is higher, what we are trying to bring out is the chance, the probability of the loss is higher. So obviously the value at risk for that kind of an instrument is also much higher. So we can very well bring out value at risk is a measure of volatility of the bank's trading book. So whatever are the investments, whatever are the assets that the bank is having, we are trying to look at, because of the market value of the assets falling down, what is the loss that the bank can incur. So it's a clear measure of the risk exposure that is associated with the trading book of the bank. So a more formal definition of the value at risk comes out as the maximum loss. We are using the word the maximum loss which can occur with X% confidence, 95, 99, over a holding period of T days. So always remember, there are three major terms that are used. The maximum loss, which is in terms of the dollar amounts, occur with X% confidence over a holding period. So any VAR definition, we will have three things. One is the amount, which is the maximum loss. Two is the time period, which is the horizon which we are talking of. Three, the confidence level, which we talk about as some kind of a percentage. So this is what comes in every definition of the VAR. If I am saying 100,000 pounds at 95% confidence level, a daily VAR. So what it means is, so now these three terms are there. What it means is, in any particular day, there is only 5% chance that the loss will be greater than 100,000. So which means in a particular day, in any randomly chosen particular day, I am very much sure, I am 95% confident that the loss will be less than or equal to 100,000. Only 5% chance that the loss can be more than 100,000. So this is the way we define the value at risk. So it's a measure of the potential loss using an estimated volatility. Formally, if you have to compute the value at risk, The major inputs that go into the computation are the volatilities, which are the standard deviations that are associated with the different assets, and the correlations that are associated between the different assets. So that is very much required, which is a measure of the volatilities of each one. Confidence interval, we have to state it ahead, and that is what goes into the computation of the value at risk. And what we see is the distribution of the underlying assets is a very crucial element in computation of value at risk. And what we see as we move along when we get into the computation process is the normality, normal distribution of the returns of the assets. That becomes a very, very interesting and essential component in the computation of VAR. Very good number of formulas which we are going to use, good number of procedures which we are going to discuss for the computation of value at risk make an explicit assumption regarding the normality. Now, whenever we are getting into the calculation of value at risk, first thing, time horizon. Define it. Do I want, right? Do I want a 1 year value at risk or yearly VAR, or do I need a daily VAR? Do I need a 10-day VAR? Do I need a weekly VAR? I can very well define for what time period the firm is estimating the potential loss. Do I want to estimate the potential loss over a daily potential loss, or a weekly or a monthly potential loss? Now, I can set it right from a daily to yearly or any kind of a frequency. But the basic yardstick is, if I am talking of more and more liquid securities, means lot of market available for buying and selling, we can look at a very short time interval like a daily VAR. Whereas when I am talking about more from an illiquid kind of securities like real estates or even any other illiquid assets where the market is not that heavy, in that case we are looking at longer time periods, preferably yearly kind of value at risk. Then we are talking about the degree of certainty, which is the probability or the confidence level for that VAR estimate. So in some cases, regulatory requirement, let's say I am bringing in Basel for the market risk, it talks about the 99% confidence level over a 10-day period. That is the way it computes the market risk. So 99% confidence interval can be used from a regulatory perspective. But in some cases, I may even look at computing 95% as well. And if at all I am talking about catastrophic situations which are very rare kind of events, and I want to look at the loss that comes from very rarely occurring kind of events, in that case a very high confidence interval is much more appropriate. So even in those cases I can look at 99. So typically wherever I am talking about some mission critical kind of applications or very rare kind of scenarios, then it's better to go with a very high confidence level. Whereas if I am talking of very general kind of risk event, then even a 95% confidence interval should be good enough. Then the next thing comes, you look at the likely returns for the instrument. So if I am taking daily data, take the daily return. If I am talking about weekly data, take the weekly return. But whatever the returns that are there, compute the probability distribution. So what is, so probably create a kind of a histogram or get a kind of a probability distribution. How much is lesser than something in between this and this? What is the chance that a return lies between this and this? What is the chance the return will lie between this and this? Get a kind of a probability distribution of the likely returns of the instrument or the portfolio. So look at the historical returns for the asset or the portfolio. Are they following some kind of a normal distribution? So basically putting, if we look at on a broader scale, the first step is determine the time period for how long you want to compute the VAR. Second is define your confidence level. Do I want 95% or 99%? Third is for your for that particular asset or the returns of the asset, look at the probability distribution. Is it following a normal distribution or a log normal distribution, or what is it is following? Once I have these three things in place, I can very well compute my VAR estimate. Now, I know the distribution. Let's say I'm looking at a normal distribution. So probably this would be the mean of the normal distribution. I have one standard deviation, two standard deviation, three standard deviations kind of, let's say the area. Now under the normal curve, corresponding to the probability that I have chosen here, let's say I have chosen 99% confidence interval here. Now corresponding to this normal distribution, I'll look at the 1% area. What is the number of standard deviations associated with 1% area, because 99% confidence interval is what I have taken. So I am looking at the 1% area under the normal curve, which is associated with this kind of a probability. Now using this, and I multiply it with the standard deviation or the volatility of this particular asset to really arrive at computation of VAR. So it's a kind of largest likely loss from the market risk that the asset or the portfolio will suffer over a time interval with the degree of certainty that is selected by the user. Right? Let's take up one example to simply calculate the value at risk. Of course, under this entire assumption. Right? Let me take up one data set which can help you in doing this calculation accordingly. Alright, let's look at this data set, for which I have taken the BSE large cap index values, mid cap and small cap index values. We'll use them as and when necessary for different aspects. So I have considered the data for the last 1 year, right from 1st April 2014 to 31st March 2015. 1 year data is what I have considered. Now as a step 1, I want to compute the daily VAR. So I have taken the daily data. The daily data is what I have taken. Here daily means the trading day. So weekends are not applicable. So these are all one single trading days. Okay, so here this first step is done for me. I want to estimate the potential loss on 1 day basis. Let's say I want to invest 100,000 on this. Right, I have 100,000. I have invested 100,000. Let's say on the BSE large cap portfolio. So this is what is my situation. Okay. Select the degree of certainty required. So I am interested in computing the 99% confidence level value at risk. So this is what I am interested in computing. But yeah, if I want 95% as well, I should be able to compute it. And this, let's say I want it for all three of them. BSE large cap, BSE mid cap, BSE small cap as well. Okay. So this is what I am interested in computing. Then I want to know the probability distribution of the likely returns. So let me assume that the likely returns are all following a normal distribution itself. Right. So I'll take the returns of large cap returns, mid cap returns and small cap returns. So for time being, let me assume that they are following a normal distribution. We know that the returns means I'll always take it as the logarithm of the ratio of the prices. So I'm computing it for all three of them, establish the same in terms of percentages. So you know this process. Okay, I'll find out the daily returns for each of these. Now, if I assume that they follow a normal distribution, so which means the mean is nothing but the average of each one of them. So we have got, this is the daily mean that is associated with each one of them. I should be able to find out the standard deviation. We know that we can find out the standard deviation using stdev.s, which is a sample specific standard deviation. We are getting the standard deviations as 0.87% for BSE large cap, mid cap, small cap. Fine. Now I am assuming that they are following a normal distribution. But to follow a normal distribution, we know that we could have done a skewness check, right? If the skewness is very close to 0, then we can talk about being normal, but we are seeing in all the three cases there is a slight negative skewness that is associated. Then we can talk about kurtosis, which also should be 0 if it has been perfectly normal, but in reality we are seeing a slightly higher number for kurtosis as well. A very positive number, much away from 0. But for the time being, let me assume that these returns are normally distributed, right? Assume that the returns are normally distributed. Now, this is where I will look at the area for 99% area under the normal curve, because I want 99% confidence interval. So I'll look at 99% area under the normal curve, which I can get using a function like norms inverse associated with, so I need 1% area under the normal curve. 99% is the confidence interval, 1% should be the rejection zone. So which is working out to be around this in all the cases. It hardly matters whatever the case we are talking of. 99% area comes associated with that number, whereas 95% area with the same logic, norms inverse, I take it with respect to 5%, I am getting a 95% confidence interval as well, around minus 1.64. Okay. Now the VAR estimate, so this is the area beneath the normal curve associated with the probability chosen. If I have chosen 99% confidence level, then the area that I would choose is this one. Whereas this much of standard deviations away from the mean. That is what it means. If I had chosen 95% confidence levels, I will choose this as my area underneath the curve. Now the simple way for me is, if at all I want to find out the 99% confidence level, I am talking about the mean plus these many standard deviations from the mean. So I'll always look at it as mean plus, because this is a 99% VAR, I'll take this as this many standard deviations away from this many standard deviations. This many standard deviations is what I am getting. So I can compute the same for all of them. So I should be able to compute and say, okay, the 99% VAR is around minus 1.93% being the return. So this negative return that I have got, I'll multiply it with the value of my investment. So 100,000 is the value of my investment. So if I try doing that and establish it in the form of number, what I am getting is minus 1933. I take the negative of this value, right, which will give me 1933. We'll talk about it. The same logic will compute first of all for 95% mean minus 1.64 times the standard deviation. This entire amount I am multiplying it with 100,000, which is the value of my portfolio. Now look at this. The 95% confidence interval VAR is 1338 and 99% confidence interval value at risk is 1933. What it means is, on a daily basis, on a single day, there is a 1% chance that my loss on the BSE large cap can go above $1,933. If I had invested 100,000, the chance that I will lose more than 1933 on a single day is going to be only 1%. Similarly, there is a 5% chance that I will be losing more than 1338 on a single day. And what we are seeing is this number is slightly higher for a mid cap and a small cap, which is an indication of the higher volatility that is associated with both these instruments. So that is how we compute the value at risk. We'll go slightly more and more detail into it, but on a broader scale, this is what is the formula that is associated with the computation of the value at risk. Now, a few interesting things. Let's understand that this is not a unified method. It's not one single formula. So this number is not one single number that